This chart tracks India's usable foreign exchange reserves in late June 1991. The line collapses to roughly $1.1 to $1.2 billion. At contemporaneous import levels, that left enough capital to cover barely 2 to 3 weeks of essential imports. Sovereign credit rating agencies, including Moody's and Standard & Poor's, downgraded India's debt in January. The immediate consequence was a sudden stop in international trade credit and commercial bank lending. The financial arteries keeping the economy running simply shut down. To avoid imminent sovereign default, the Reserve Bank of India executed an emergency collateralized borrowing operation. Over May and June, 47 tons of national gold reserves were quietly airlifted and pledged to the Bank of England to raise roughly $405 million in emergency funding. The 1991 crisis represented the mathematical collapse of a heavily restricted, debt-financed economy. This systemic failure forced the Singh administration to implement a structural reform program, dismantling the architecture of the license permit Raj. To understand the failure of 1991, we have to look at the structural preconditions built up over the previous decade. Under the Rajiv Gandhi administration from 1984 to 1989, India pursued a debt-financed expansionary fiscal policy. This graph maps the resulting twin deficit expansion. On the left axis, the central government's fiscal deficit widened from roughly 6% of GDP in 1980 to 8.4% by 1990. On the right, total external debt climbed from $20.6 billion to nearly $83.8 billion over the same period. The composition of that debt was shifting dangerously. Rather than relying on concessional multilateral aid, an increasing share was short-term commercial borrowing. The volume of debt maturing in under a year expanded rapidly, forming a wedge that dwarfed the country's actual foreign exchange reserves. This specific relationship, the ratio of short-term debt to reserves, became a critical vulnerability metric. Following the Indian experience, international financial institutions adopted this exact ratio as a standard early warning indicator for assessing sovereign crisis risk. By 1990, India's external debt service consumed 30.2% of its current receipts. The World Bank's internal classification system at the time treated that specific threshold as a marker of severe external payment strain. The underlying twin deficits, fiscal and current account, had engineered an unsustainable trajectory. The state was heavily reliant on volatile funding sources, specifically non-resident Indian foreign currency deposits, leaving the economy exposed long before any external shock materialized. The proximate external trigger arrived on August 2, 1990, when Iraq invaded Kuwait. This diagram illustrates the immediate financial cascade. Global crude prices doubled from roughly $17 a barrel in July to a peak of $36 by October. Because India imported up to 70% of its petroleum, this added an estimated $2 to $2.5 billion to the annualized import bill, striking an already depleted reserve base. The war imposed secondary costs on the balance of payments. Remittance inflows from the Gulf were disrupted, and the state had to finance the logistical evacuation of over 100,000 Indian workers from Kuwait and Iraq. This external shock hit an executive vacuum. The domestic political sequence saw the VP Singh government collapse in November 1990, followed by the successor Chandrasekhar government falling after barely 5 months in power. The ensuing general election campaign was interrupted by the assassination of former Prime Minister Rajiv Gandhi on May 21, 1991. For 7 months, India had no stable mandate to negotiate a coordinated policy response. This political paralysis occurred at the exact moment external creditors and rating agencies were reassessing the country's repayment capacity, triggering a sharp withdrawal of non-resident Indian deposits precisely when financing was needed most. The chronological alignment of a severe commodity shock with domestic political paralysis transformed a manageable fiscal strain into an unmanageable sudden stop of capital. By late June, PV, Narasimha Rao was sworn in as Prime Minister, appointing Manmohan Singh as Finance Minister. Their immediate priority was technocratic triage to halt the bleeding. This chart tracks the initial monetary response. The Reserve Bank of India executed a 2-step devaluation of the rupee on July 1 and July 3, driving a cumulative 18 to 19% depreciation against the US dollar. moving the rate from roughly 21.2 to 25.8. The central bank deliberately structured this as two smaller adjustments, rather than a single large announcement. This tactic was designed to minimize political visibility, while preventing speculative anticipation in the markets. With the currency adjusted, India signed a standby arrangement with the International Monetary Fund on July 4, securing drawing rights for roughly $2.3 billion. The devaluation and IMF emergency lending provided the necessary liquidity to avoid a sovereign default. However, the explicit structural conditionality attached to that lending mandated an overhaul of the Indian economy. The legislative pivot occurred on July 24, 1991, with the simultaneous presentation of the new industrial policy and the new trade policy. The industrial policy dismantled the core of the Industries Act of 1951. Compulsory industrial licensing was abolished for all but 18 designated strategic sectors. Simultaneously, the state eliminated the Monopolies and Restrictive Trade Practices Act's asset size thresholds, which had previously blocked large industrial houses from expanding capacity. Trade liberalization was equally aggressive. Import licensing for the large majority of capital goods and intermediate inputs was immediately abolished. In a single step, the July budget cut the peak customs tariff rate from 355% down to 150%, initiating a downward trend that would reach 40% by 1997. Foreign direct investment constraints were lifted. The restrictive 40% foreign equity ceiling, a hallmark of the 1970s, was raised to allow 51% automatic approval in 34 designated high-priority industries, reversing a posture that had previously forced multinational exits. By March 1992, the state introduced a dual exchange rate transition mechanism. Exactly 1 year later, that transitional system was unified into a market-determined floating exchange rate. These concurrent actions reverse the logic of the license permit Raj. In under 2 years, the legislative framework shifted from a state-directed closed system into a market-determined, globally exposed architecture. By the 1996 to 1997 fiscal year, the macroeconomic outcomes of these first-generation measures had worked through the system. This dashboard compares the crisis point to the post-reform recovery. The headline stabilization is clear. Usable foreign exchange reserves rebounded to $26.4 billion, covering roughly 8 months of imports. Meanwhile, the central fiscal deficit narrowed to 4.9% of GDP. Foreign capital integration surged. Annual foreign direct investment inflows increased from $97 million in 1990 to $3.6 billion, a 37-fold increase over 7 years. A debate over policy ownership persists regarding whether these changes were internally driven or externally forced. Historical data shows that while IMF conditionality dictated the implementation timeline, the specific reform menu had domestic technocratic provenance dating back to internal studies in the mid-1980s. However, this matrix reveals a structural asymmetry. The liberalization of trade policy and industrial licensing was not matched across all sectors. Progress on financial sector reform stretched out for a decade, and stalled progress on labor market regulations left existing restrictive provisions substantially unreformed. The 1991 reforms resolved the acute balance of payments crisis and supported a growth acceleration. Yet this asymmetrical liberalization left a manufacturing sector operating with rigid labor laws behind a still substantial tariff wall. That dynamic hardwired structural gaps into the economy, creating the persistent jobless growth and premature deindustrialization debates that define the Indian political economy today.